Okay, guys, we're back with another episode of What's on Your Mind. I'm Chris Quill, and today on the show I've got Edward Shek and Jason McDonald joining me, both ITPM senior trading mentors. They're going to be talking about their current perspective on markets and also their own portfolios. So, gents, fantastic to have you on as always. And we're going to kick off today, I think, with Jason. What are your thoughts?
Hi, everybody. Freshly into the new year. Haven't been on here for some time, so good to be back. First of all, just kick off with some very basic observations. So we obviously had a bit of an interesting start to the year, and on that subject, I'd say that very different to the beginning of last year. So I think this year is, we're always running long short, as everyone knows, but I think this year is going to be a really good year again for stock picking, as opposed to last year when we came in when there was a fairly strong, obvious directional bias that was going to be the case. I think it's definitely quite a different situation now, real stock pickers market. So as I say, pretty rough start to the year at the index level, and some of the mid caps growth stocks obviously got completely hammered. But interestingly now, as of last night's close, and that doesn't take into account what's happening with the futures today pre-market, given the results from Alphabet last night. But where we sit as of yesterday's close is we've got the VIX way back now at 22. I think it went below 22 actually for the first time since mid-Jan. We've got WTI, still up there just sub 90. And we've got, the S&P and the NASDAQ 100 have really made back a lot of their losses. They're, down 4.5% and 8% respectively year to date. So quite a recovery. And that's just really, FYI. I just want to speak about, I know that inflation has been spoken about a lot here, but I'm just going to talk a little bit about European inflation. So we got the German numbers for January, and they were up at 5.1% year on year, which is down from the peak the previous month of 5.7%, but still way above consensus estimates of 4.7%, and almost triple the 2% target for the ECB. Similarly strong in Spain. We saw a 6.1% increase in CPI for January. Down from 6.5% in December, but also well above the expected 5.5%. So inflation clearly still an issue in Europe. And if we think about, what the kind of market's been up to in the US, just want to put that into context. Now, Christine Lagarde, head of the ECB, has been out there. I just find her fairly, she's either smoking some good stuff or she's incredibly arrogant. I think a bit of both, but she's out there as recently as last week saying that her staff are penciling in a return to below 2% by the end of this year, and heading lower in 2023-24 towards 1.8%. That is remarkable, I think, and kind of is slightly worrying, I'd say. Just to remind people, at the moment, the deposit rate in Europe is still at a record low at minus 50 basis points, and it's been negative since 2014. She's still saying no rate hikes in 2022. The market begs to differ. The market is now saying, in terms of interest rate futures, 10 basis points increase in September and a total of 25 basis points by year end. And I would suggest that that is potentially only the beginning. If we look around the world at the stock of negative yielding debt, the volume of negative yielding euro denominated debt has fallen from 5.1 trillion euros in December to 4.38 trillion at the end of January. That's a fairly big reduction in just over a month. Which means that now for the first time in a long time, less than 48% of sovereign debt in the Eurozone is actually yielding less than nothing. And that was up at a peak of 56% at the end of last year. And if you look globally, that negative yielding debt number is coming down rapidly, which obviously has implications for yield. So it's now $8.2 trillion globally that we have of negative yielding debt, compared to a peak of 18.3 trillion at the end of 2020. So, we have real change afoot here. And just lastly, to put this into context, if we think about what's been going on in the US, the ECB's balance sheet is equivalent to 62% of estimated 2022 nominal GDP for the euro area. Now, the Fed, their balance sheet is only 35% of US GDP. So, I just want people to kind of have a little bit to think about that. And just in summary, as somebody who's head of rates at a fairly large London-based asset manager said last week, as some of the stimulus from the ECB buying recedes, people will be forced to look at fundamentals and say, why am I holding this? And I would, very much agree with that. So now I'm going to move on to my first idea. I've got two long ideas today. Now, one of them is higher conviction than the other. I'm going to talk about the higher conviction idea first, and that's not a surprising thing. We don't kind of have this rather neat portfolio of situations where everything is exactly the same size and everything is exactly with the same conviction. So it's very usual for us as traders to have a stronger view on some situations than we do on others. And obviously that has an implication in terms of how we risk manage and how we size positions. So this is my higher conviction idea for this week, which is it's a stock called Cameco, ticker CCJ, market cap $7.75 billion, share price as of yesterday's close $20.24. So what do these guys do? Well, they are the top North American uranium miner. They're also the world's number 2 uranium miner. Their competitive position is basically around a controlling ownership of the world's largest high-grade uranium reserves and also the lowest cost operations. So their uranium products are used to generate clean electricity in nuclear power plants globally. They also explore for uranium in the Americas, Australia, and Asia. So they produce uranium oxide, so U3O8 is the chemical symbol. They produce that concentrate, and they also own a conversion facility, which is one of only 4 operating around the world. So you can imagine this is a fairly specialized business. And the way that it works is that you've got 4 stages. So you've got the extraction, the conversion, the enrichment, and then the fabrication. So you begin with the oxide, which is the U3O8. This, at the end of it, will become fuel rods, which are packed with enriched uranium pellets. Start to finish, that process from the beginning of the extraction to becoming rods, that can take up to 2 years, and bringing a new mine into production can take up to 10 years. So as you can understand, this is an industry with very long kind of lead times, and it's a very specialized enterprise. Only 6 operators around the world possess the infrastructure and the know-how with which to meet global demand for uranium. For that reason, historically, the supply contracts were long-term, because, of course, if you're running a nuclear plant, you cannot risk having to shut down the reactor because of a lack of fuel. That's quite a technical situation, which led to these long-term contracts. Now I'll talk more about the uranium market in a moment. We'll just get the quantitative analysis out of the way. There aren't that many of these guys listed, so really CCJ kind of stands alone. So I'm only going to give you the quants for CCJ on a standalone basis. So we haven't yet reported on 2021 Q4, but we have had Q3. So we're looking at most likely a loss of 19 cents per share for the whole of last year. And then this year swinging into profit from a loss of 19 cents per share to a profit of 28 cents per share this year. And then the analysts have got penciled in 24 cents EPS for 2023, which again, I think, maybe a bone of contention, certainly from my perspective. which clearly means that, you know, if you're swinging from loss to profit, you've got an enormous growth rate there, of course, that's kind of meaningless in percentage terms for this year. I don't think we're going to see earnings drop for 2023, and I'll come on to that. PE basis, this thing is on 68 times 2022, 79 times 2023, and also you're not going into this stock for its dividend yield, which is a paltry 32 basis points, which I guess is better than a lot of that that euro denominated debt, but you know, we'll get back onto that. So the top down macro behind this idea, for those of you that don't know, after the accident at Fukushima in Japan at the nuclear plant there in March 2011, that kind of was the onset of the uranium bear market. And so that lasted for quite a long time. You know, it wasn't until the end of 2019, so a good, you know, almost 9 years later, when supply really started to tighten back up again, and supply and demand for uranium basically began to balance at that point. And since then, we've seen a gradual increase and an improvement in uranium prices. And we'll put a chart up of that to show you. So the question is, how quickly, now that we are running potentially into a deficit situation, how quickly is that going to feed through into uranium prices? And I'm basically saying that, you know, that this year could be the year when uranium really does take off. Now, the cycle for uranium, as I kind of indicated earlier, is quite a long-term cycle. It's fairly unique, even, you know, in the commodities world. So supply is very slow to pick up on changes in demand, and the other way around as well. So demand is also slow to respond to changes in supply. It can take a decade to develop a mine and to build a reactor, and that's also how long the price cycle in uranium can last. If you think about it, you know, Fukushima was in 2011, wasn't really until 2020, 21 that we started to see, you know, a proper kind of basing of the price. Now, to give you a bit of an idea on the demand supply situation, for last year, we're expecting consumption to have been to the tune of 178 million pounds of uranium. But miners were forecast to have only extracted 166 million pounds of uranium for last year. So that's already obviously a deficit of 12 million pounds on an annual basis. Now, inventory is obviously built up after the Fukushima accident, so they have been filling the gap. But now we're actually seeing an increase in uranium demand. So according to the World Nuclear Association, last year, approximately 50 reactors were under construction as of last summer, compared to a stock of globally 440. So that's a fairly significant number. And also, interestingly, last year, producers of uranium actually became consumers in the futures market. So they are actually betting themselves on higher prices because they've reduced their production by so much. If we look at the estimated remaining life of the world's major mines in uranium, we can already see a supply-demand problem that's already occurring, and it's just going to get more intense over the next few years. We've seen 33.5 million pounds a year removed from the market because of production cuts. That's about 20% of demand. And if you look at the potential projects out there that are, you know, supposedly going to replace that loss, and even if we assume that they're going to go into production on time and produce the type of volumes predicted, which never ever happens, you're not even going to get to half of that 33.5 million pounds a year that's basically now removed from the market. Now, in terms of prices, the price is currently around $45. Now, some estimates are out there that miners need a price of $60 plus to start generating the capacity to meet demand. And indeed, the Cameco CEO, Timothy Gitzel, said on one of the earnings calls last year that we should be investing now to replace that lost production. But at today's prices, that makes 0 sense. And, you know, if you're bullish on uranium, which clearly I am, what we're waiting for now is for the utilities to start to contract again on a long-term basis. Now, they haven't felt the need to do that yet because spot prices have remained, fairly low. So they see no urgency to to sign supply deals. I beg to differ. I think they're behind the curve on that. And the numbers are fairly, they're fairly meaningful. I mean, we're expecting customers, i.e., buyers, to need to secure £1.5 billion of uranium over the next decade, and that's not a very that is not an insignificant amount. And indeed, Gitzel again, so this is the Cameco CEO, said in their May 7th earnings call last year that if we back that up to when it's needed, this is the 1.5 billion tons of demand. Sorry, 1.5 billion pounds of demand. If we back that up to when it's needed to be contracted, produced, and delivered, that requires 140 million pounds of long-term contracting per year, starting last year, i.e., 2020. And in that year, we saw 50 million pounds placed under long-term contract. So that demand is piling up in a future window. That's from the CCJ CEO. So essentially, pretty easy to understand this idea. It's a call on high uranium prices. Now, to put it into context, this company, as we saw, it's not in inverted commas cheap by any kind of metrics that we would normally use. But to give you an idea, its current market cap is 7.5 billion or 7.75 billion now. It's had a little bit of a rally in the last couple of days. In the previous bull market in 2007, this company had a market cap of 20 billion. So that's the kind of context that we could bear in mind here. As I say, you're not really going to look at it on traditional valuation metrics. But what we do know is that there's a growing supply-demand problem. The sector's been in a 10-year bear market. I think we're at close to a major inflection point in that market. Now, what are the potential threats here? Well, the owner of the largest uranium miner globally is the Kazakhstan government. That is an opaque situation. Although actually what we did see with the issues that occurred in Kazakhstan at the end of last year was we saw a big spike in the uranium price, which then dissipated, but that was on the back of the civil unrest that occurred there. So in a way, this actually might help the uranium price, but we'll see. That is a potential unknown there. So in terms of catalysts, I'm looking for upgrades to 2022, 23 EPS. I'm looking for a potential spike in the U308 price. We've got next earnings report is next week, February the 9th, before the market opens. My target for the stock price is 24.25 by the end of March. Potentially, I think there's some juice to get out of the March 18th, 1924 vertical call spread, which, when I looked a couple of days ago, was costing around $1.40. But also, I'd play this through stock as well. So I'd be looking at both the options, obviously on the call side with some kind of call strategy for around March, April, and also long stock.
Awesome. That sounds like a great idea. Good to hear about something in the sort of energy sector as well that could be high growth. Ed, let's go over to you and talk about what you want to think about.
Yeah, I just want to frame it first, just to remind everyone that these are never sort of standalone stock ideas. They're very much within each mentor's long-short equity portfolio, expressing a bias and risk that we're happy to run with. So just to bring it slightly into the current macro. So my first long idea is actually IT, DigitalOcean, DOCN. But my book has been running net short since November, when Jerome Powell went hawkish. It was a relatively straightforward trade, just to be short, slightly smaller market cap, high price to sales, 25, 30 plus, that are losing money. So that trade has played out very nicely. And over the last week, I've been reducing that net short, and now I'm adding tech to the book. I give you the bit of context, because what I'm not saying is this is a technical bounce. I'm just not looking at stocks that are down 50, 60%. They've gone up 2 days, and somehow I think there's some technical upside for another 25%. I'm also not saying I have a strong view on inflation, whether it's going to accelerate and run hotter from here, or whether it's going to peak out and the yield curve will flatten and possibly reduce. So it's in the context now of being effectively flat to slightly long tech. So we'll come on to DigitalOcean. So this is Internet Services and Infrastructure. It's a $6.5 billion company. It provides cloud computing platform. So it offers infrastructure and platform tools for developers, startups, and small and medium-sized businesses. So it's designed to simplify cloud computing, enabling developers to deploy and scale applications, infrastructure, solutions across computing, networking, and storage. It operates under several verticals, including web and mobile applications, web hosting, e-commerce, gaming, and media. And the end users ultimately are just software engineers, data scientists, researchers, systems administrators. I love this, individuals and hobbyists. I don't think I've ever met a hobbyist, but anyway. Now, here's the interesting thing, right? Final bit of context. In November, before the Fed went hawkish, you could have looked at Procter & Gamble. Staple, horrible looking quants like staples always have. Stock was at 140. It's now at 160. DigitalOcean has amazing quants. So full year revenue up 30, earnings plus 125%. Stock's down 60%. So it's a reminder that you can't just screen quants, say here's a good looking set, and think the stocks are just going to rally. Now, when we do look at the quants, as I said, we've got 34% earnings growth this year, 126 revenue growth, and 126% earnings growth. In and of itself, good looking quants. Now, I've traded this last year, and what I do know is 6 months ago, full year was expected to be 21 cents. It's now 34. 2023 earnings was 50 cents 6 months ago. Now it's 58. So when I look at the static quants, I know that earnings are still getting upgraded, and that's very, very important. When we look out 2 years, this company's got projected revenue growth of 34%, 32% for the next 2 years. So that's great. What I really like, though, is earnings are expected to grow 71% for 2022 and 81% for 2023. So they, on the face of it, look like outstanding quants. Now, what's the valuation? It's come down from over 20 times to 9.5 times. Now, I'm not even saying that's value, that's too high, that's too low. Remember, I'm still short some tech names that are losing money and have much higher price to sales. I'm buying a stock with good quants. But as we know, as they report full year soon, whether they beat or miss isn't actually that important. What's important is the guidance. It is always about the guidance, especially, as Jason said, about stock picking. As interest rate expectations ratchet up, valuation multiples are going to compress. So for stocks to rally, you really need that EPS to actually be getting guided up. All right. The whole concern now is what's consensus estimates for the year ahead and the year beyond. So the quants are good. What about the competition? Something like a GoDaddy growing its revenues 25%, similar. It's going to make 40% earnings growth this year, 15 in 2023. It's only on 4 times sales. So it's more than half, it's half the price, but the earnings growth is less than half. So I'm not that interested. Wix, revenue growth 25%, still losing money this year, still losing money next year, not interested. Fastly, 20% revenue growth, losing money, 7 times sales. So it's got great quants. Can they actually beat estimates? We like it versus its competitors. So have a quick look in the last earnings report. We look at the KPIs, average recurring revenue, average revenue per user, net dollar retention, and are they growing the client base? So the client base has grown 7% in the last quarter year on year. So they've now gone from 550 to 600,000 customers. Fine. Average recurring revenue is up 36% at the Q3 level year on year, but it's gone up from the Q2 year on year. So this is very important. The KPIs are great, but they're actually improving. Average revenue per user up 28%. Again, very strong. Net dollar retention. So this is a metric that simply says, if your customer paid you 100 last year, how much is it paying you this year? And it's gone from 104 to 116. Their client base is growing, not spectacularly. Their clients are staying. Their clients are spending more each year. And that's why you're getting such big earnings leverage. Their cost base is pretty much not moving in this part of the business, and it's just all gravy. What about the total addressable market? There's no point if they've got no customers left to mine, then it's going to go ex-growth very quickly. So when I was reading the Public Cloud Services Spending Guide, another great read in the Shek household, individuals and companies less than 500 have an addressable market of $44 billion in 2020. 2024, that's expected to be 120 billion. So that's 27% compound annual growth rate. That's extremely good. But DigitalOcean is growing far faster than the fast growing market. You just have to look at the numbers. So they are market leaders in a fast growing market. They're taking more and more of the share, more and more of the leverage. So you can see a clear pathway to this market that they're dominant in, just getting bigger and bigger and bigger. That's very good visibility. The final thing I like is, can they actually scale into different markets? So if you think about it, DigitalOcean are number one, but they're in the shallow end of the market cap pool. Amazon Web Services, they're wallowing around in the deep end, $750 billion business, complicated products, sophisticated, expensive, dealing with tens of thousands of employees, multinational. DigitalOcean are market leaders, simple, off the peg, easy to use, cheap. And now they are investing to get a more sophisticated product to go further into slightly into the deeper water. That's not in the numbers at all. So they're opening up potentially a new addressable market, and that's very good. Obviously, they've got a differentiated product. It's open source. So if you're a customer, you don't get hit with the proprietary stack. So you pay for what you use, you get billed monthly, you're not tucked into long contracts, and it's a great product. Now we come to the entry point. The stock was 125 or higher in November. Last week it was 50. So it's had a nice de-rating. We think it's a great entry point when we're covering a net short. But interestingly enough, when vol's high and the market sold off, you've always got to just remind yourself what expected returns are. So when I put this trade on, I just did a March vertical. So you buy the March 50s, sell the 75s, you get a 3 for 1. That's great. But you're asking the stock to go up 50%. So you have to ask yourself the question, are we really in that sort of market for tech shares? Okay. Really, if the stock's going to go up 50%, you want to make more than 3 to 1. So I actually opted for buying it. Well, if you were trading it today, I think the best way is to buy the March 60s, sell the the Feb 70s. So just do a 2 for 1 ratio calendar. You can still collect your credit all the way up to 70. We want the stock to rally, but we want to collect the credit. We don't want it to go above 70. Then you're long for earnings, good earnings. Then you set up the March vertical. Now, the trigger for me for actually buying this last week, funnily enough, came from Atlassian, the ticker's team. So when I go through earnings, I try and look at which factors of stocks are reporting well, and more importantly, how do they trade afterwards? So little old team, here's a stock that's trading on 30 times sales. Obviously, it's been hammered like they all have, but it posted market-beating numbers, upgraded 2022, and rallied 10% and held. So that again was a little trigger. Because what I wanted to see is, do they have great numbers, upgrade, and the stock still goes down 15% because it's on 30 times sales? So it's comforting that now maybe the market's calmed down. Jason said the VIX is back to a better level for initiating option spreads, and that's DigitalOcean.
Awesome. Another really good one. And I like how you kind of made sure you framed it in the context of the portfolio as well. To tell people where you're at, basically. Jason, let's go over to you again.
Yeah. Okay. So I've got another long idea. As mentioned at the beginning, Not as high conviction as the first one, but still, still another long position. So the company is called Mohawk Industries, tickers MHK, market cap $10.7 billion, closing price last night $158.61. So what do these guys do? Pretty simple business to understand. They are a manufacturer of flooring products for residential and commercial properties. So basically carpets, rugs, ceramic tiles, laminate, wood, stone, vinyl flooring. Present all over the place, global company. So present in clearly the US, Australia, Brazil, Canada, Europe, India, Malaysia, Mexico, New Zealand, and Russia. They've actually, this is part of the story here, they've reorganized their business into three segments, which are called Flooring North America, Global Ceramic, and Flooring Rest of the World. So the North America flooring segment is the biggest. That was 37.5% of 2020 sales. So what's in there is, carpets, rugs, carpet pad, hardwood, laminate, and this thing called LVT, luxury vinyl tile. It's, as the name suggests of this segment, it's the North American operations. And some of our American friends out there will be familiar with some of the brand names here. So, the brands that are thrown into that segment are things like Aladdin, Columbia Flooring, Bigelow. Then you've got the second largest segment, which is almost as big, at 35.9% of 2020 sales, called Global Ceramic. Again, similar kind of products, ceramic tile, porcelain tile, natural stone. They've got various brands under that umbrella. And then the smallest of the segments is the Rest of the World flooring segment, which is about 26.5% of sales, which is, similar kind of products. Again, laminate, hardwood, some roofing elements, MDF, chipboards, and our friend LVT. And that's basically the business in Europe and the rest of the world. So onto the quants. Now this one is it's a proper turnaround story, and I'm going to come into that. So it doesn't screen well at the moment on the quant basis. It's not our typical sort of long profile that we look for at ITPM, but as Shek has mentioned, this is all part of a portfolio. So we diversify not just across names and sectors, but also in terms of different types of ideas. So these guys, they are, they're predicted to make EPS this year of $15.50 and next year $17.11, which equates to an EPS growth rate, very paltry this year of 5%, and next year looking at earnings growth, just into double digits. So that compares to the sector, which is predicted to grow at 16% this year and 16% next year. As you'd expect, with a turnaround and with those types of numbers, these guys are trading at a fairly hefty discount to the peer group. So they're trading on 10 times this year, 9 times next year, compared to the sector, which is on 22 times this year and 19 times next year. So as I say, not the profile necessarily that we traditionally will look for. Now, what's behind the idea? So first of all, these guys have got, they've got proper market power here. So one of the interesting aspects of this business is that most Americans shop for their flooring at small kind of specialty shops rather than, the big box retail type places. So that means that key to that is distribution. So Mohawk owns a fleet of more than 750 trucks, which would, if they were an independent trucking company, would actually make them the 5th largest trucking company in the US, which is fairly interesting. And that is a formidable barrier to entry. So they, in 2020, were which is the last year that we've got the figures for, Mohawk was the biggest American flooring company with 25.1% market share, followed very closely by a company called Shaw Industries, which is owned by Berkshire Hathaway, with 24.9%. And then the rest of the industry is quite fragmented. So the next 8 largest flooring companies in the States control 20% of sales. So basically, Mohawk and Shaw are the real dominant players here. So Mohawk, the story is, these guys were kind of acquisition kings. They made 48 acquisitions since they IPO'd. And at first, that strategy was a good one. So, in the 5 years ending 2017, Mohawk was trading at a premium, at a really healthy premium in terms of P ratios to both its peer group and the general market. Now that story starts to kind of unravel in 2018-19, where this luxury vinyl tiling story comes into play. So LVT, to give you an idea, in the US grew by almost 200% between 2016 and 2021. So it's basically the flooring, that part of the flooring segment that was taking share from all the other categories. So that was where the action was. Now, what is LVT? It's they're interlocking vinyl tiles that basically look like you can have, they look like stone, ceramic, or wood, and they also form a waterproof barrier over the subfloor. And importantly, they're cheap and quick to install. And by comparison to laminate flooring, the LVT doesn't leak, whereas laminate does. So quite a popular growth part of the market there. And these guys essentially messed up on the LVT front. So what they did was they constructed 2 new facilities in Georgia and decided to manufacture their LVT domestically. Everybody else moved their construction to China. So as a result, for Mohawk, their capex went through the roof in 2017-18. And to put that into context, their operating margins fell to 8.3% of sales in 2019 from 14.3% 2 years previously, which also, as you'd expect, meant that operating income went through the floor. That went down by 38% over those 2 years, from 1.35 billion down to 827 million. Now, the turnaround has been, it's been in progress now for quite a long time. So I think, we're definitely towards the end of that. So what have these guys done? Well, the first thing is that they've resolved the manufacturing difficulties they had at the 2 factories in Georgia. And in fact, they're now building a third. So they've got that well under control. They've implemented a cost-cutting program to the tune of about $100 million, again, to align their manufacturing capacity with demand. They've managed to, through the first 9 months of last year, which is, the results that we have at the moment, they managed to actually increase their gross margins by 5.5%, which is a really significant increase. And so in the last 12 months, operating margins have recovered from a low of 8.3% in 2019 to now 12.3% in the last 12 months. And starting beginning of this year, so very much recently, beginning of this year, they are increasing their prices. So they've got this market pricing power. So they're increasing their prices across all of their businesses in every geography, in every product, to the tune of between 10 and 15%, depending on the product. So that's another plank, to this recovery story. Now, we talk about share buybacks and share purchases quite a bit. They're fairly commonplace because of, what's happened to, particularly what's happened to the cost of debt. However, these guys, I think it's worth pointing out that they, in the first 9 months of last year, they bought just shy of $500 million worth of stock. Now, bearing in mind the current market cap is 10 billion, okay? In Q3, they've actually increased the quarterly pace of buybacks, almost doubling it from $123 million a quarter to $209 million. And in middle of September, they've authorized an additional $500 million of repurchases of stock, in comparison to a market cap of 10 billion. Now, this is not being done at the expense of ruining the balance sheet, because the balance sheet, in terms of net debt, including operating leases, is $1.6 billion, which is less than 1 times 2021's EBITDA. Okay. And the operating income for Q3, which, as I said earlier, is the last results that we have for these guys, that covered interest expense to the tune of 24 times. So these guys are not, putting these buybacks in place and ruining the balance sheet. In terms of the analyst coverage, there is definitely scope here for upgrades. That we've got 10 holds, 2 sells, and only 6 buys. So I think we could see upgrades coming through there. Basically, my argument here is this thing, given the relative valuation drop since 2018, I think maybe all the bad news is kind of in the price now. It's got a very low short interest of about 1.5%. And also, I think quite importantly, the chairman, CEO, through direct stakes and indirect family trusts and things like that, he controls 14.5% of the outstanding shares. So he is definitely incentivized for this recovery to really take place and boost that share price. So in terms of the last earnings report, which was the Q3 last year, that was a pretty bad report. The adjusted EPS was fine. That was $3.95 per share, compared to consensus estimates of $3.81. But they were a bit bearish on the guidance for Q4. So they brought that down to 280 to 290 on the range, compared to consensus expectations of $3.20. Now, they said that was down to an increase in European energy costs. And as I mentioned earlier, they have been implementing price increases across the board for all of their segments and products everywhere since the beginning of the year. So I think they're going to get that back. So what are the catalysts here? Well, I think it's a general situation where I think that essentially all of the bad news is now in the price. Is it now old news in effect? As I say, margins are increasing, prices for their products are going up. We've got next earnings is next week again, after the market, February the 10th. I've got a fairly bullish target, up 20% from here in terms of price by the end of April. So that'll take it up to the mid 180s, high 180s, so 185, 188. The options market isn't offering us much at the moment. I had a little bit of a look at some calendars. You'd need to work at it to get it, to pay off. So really for this one, I think, it's basically a long stock situation.
Awesome. Well, gents, I think we'll finish up there. It's been great to have you both on. You've both delivered a ton of information today that I'm sure our viewers will find useful. I thought it was interesting how throughout most of the stocks that you both mentioned today, actually, you're always talking about stocks that had a strong market position with some sort of strong competitive advantage as well, and within strong sectors. So yeah, thank you both for coming on and talking about those. Now, for you guys watching, if you enjoyed this episode of What's on Your Mind, then you're going to be sure to enjoy one of our events coming up at ITPM, which is our WOYM event. That's starting on the 31st of March, and it runs for 10 trading days. It covers things like long-short idea generation, portfolio management, catalysts, key performance indicators, lots of the stuff that these guys actually mentioned in this episode as well. We go through all of that throughout the 10 days, and all of those topics are talked through by our senior trading mentors like we have here, Jason and Ed, and all of the other guys that you see on What's on Your Mind episodes as well. And another thing that's really good about that event actually is that throughout the 10 days, what we try to do is kind of approach it in a practical way by taking ideas from attendees and building a portfolio that's relevant to the current market as well. So it's really interesting, really practical. We always get great feedback. And if you're interested in that, then definitely sign up. And you can do that by going to our website, itpm.com. And of course, if you're interested in some of our other products, then you can check out information about all of those as well. So that's other events, our courses, our mentoring programs, and so on. That's it for now, though, from us. Thank you all for watching, and we hope to see you next time for another episode of What's on Your Mind.